You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Awesome. Hey everyone, welcome back to another episode of Market Champions. Today, I've got my friend Andy Fitelli on. Andy's the author of the fxpoet. Before this, Andy has had an awesome career, both in trading as well as in sales at some of the biggest banks in the world. Andy, thank you so much for being on the podcast. It's wonderful to have you here.
Thanks a lot, Sri. It's really an honor. In fact, the first podcast I've ever been on.
I appreciate that. Andy, could you start by telling a little bit about yourself to the audience? Your background, how you got into finance, and sort of your career. You started back in the '80s, and so it's been a long career, and so that's which I think is absolutely fantastic.
So yes, it has been a long career. It just means that if you live long enough, you can do things for a long time. It's funny, when I was in school and college. I really didn't know what I wanted to do. I went to MIT, and I expected I'd be an engineer because when you go to MIT, you sort of expect to be an engineer. And all my fraternity brothers were engineers, and I hated engineering. I hated every aspect of it. And so I was looking for something else, and I wound up taking both, interestingly enough, urban studies, and I sort of split a year with urban studies and finance. And finance was what really triggered it a bit. But so at that point, I kind of had an idea that's what the broad industry I was going to be in, but I didn't really know what I wanted to do. And then I had a summer job the summer between my junior and senior years in college. And I was working at a company called Oppenheimer and Company. It still exists. At the time, it was a small broker dealer. I think they're mostly a fund managing company now. And the summer programs back then, now the banks, they all have this whole, they interview, they go to campuses, they post jobs, all this big analyst program. Back then it was the friends and family program. My mom knew somebody who was a broker there. He suggested that they bring me in. And so I did, my initial assignment was to be in I was helping the discount drug analyst. So now you have to remember, this is 1979, and there's no internet. There's no, there are no personal computers. Computers are mainframes, and that's all they are. And my job was to get data out of 10Ks and 10Qs in the library in the firm. So it wasn't that exciting. But they seated me in the institutional investor sales area. And there was a speaker in the ceiling, and periodically a voice would come over and say something like, I got 100,000 knockout to sell, which I particularly remember. So at one point I turned around to the woman who sat behind me and I said, who is that? What is he talking about? And she said, oh, his name was Jeffrey Mail. I said, that's Jeffrey. He's on the trading floor. And I said, well, what's the trading floor? She said, you've never seen the trading floor? You have to come down and see. So they had a spiral staircase. We were in One New York Plaza. We went down a flight of stairs. Opened the door to the trading floor, and I had an epiphany. I said, now I know what I'm going to do with my life. I'd never seen an environment like that. The electricity in the air was just mesmerizing to me. So a very funny story I will tell is subsequently there was a breakfast for the summer interns, and I knew one other kid. We sat at a table. There's another kid, and an older gentleman sits down. And he starts, talking to us and asking us about, what we're doing. And I told him that exact story. And he said, well, why don't you get a job on the trading floor? And I said, I didn't know it was so easy to do that. And he said, well, go talk to Danny Murphy, who was the man who ran the entire trading floor for Oppenheimer, and tell him Jack Nash told him to give you a job. And I said, okay. I had no idea who Jack Nash was. I go down later that afternoon. I find Danny Murphy. I tell him, and the following Monday, I started on the trading floor. Turns out Jack Nash was chairman of the board. so it was a great concept of ignorance is bliss, because I don't know that I would have told the story, that I would have done anything had I known that he was chairman of the board. He was just a guy there. An important lesson. They're just people too. Anyway, so I started there, went back and really focused on my finance work in school, and decided I wanted to get into the foreign exchange markets. And so took a number of international finance courses, finance theory courses of that nature, got out, and went to work for JP Morgan and Company. It was way before JP Morgan Chase existed. This was just JP Morgan. It was actually Morgan Guarantee Trust Company was actually who I worked for. But it was a back office role. I was very unhappy. I wanted to get out front onto the trading floor. I wound up actually going back to Oppenheimer. My Oppenheimer summer was fantastic. I had a great time there. They offered me a job. They wanted me to stay, said, don't go back to school. I said, I don't think my folks would be really up for that. And so I went back to Oppenheimer for a while, and I started my master's degree at night at that time. And then after a period there, I finished up my master's and got into the foreign exchange markets. And so my first role was at a company, a bank that no longer exists independently. It's called Swiss Bank Corporation. It is now, that's part of UBS, the United Bank of Switzerland. It merged with Union Bank of Switzerland to become the United Bank of Switzerland. And that's where I started in FX, and that was in 1983. So just as an indication, I'm actually just looking on my screens right now. Everyone's making a very big deal about dollar yen being 136.20. Here we are. And in fairness, it's the highest we've been in 20 odd years. I guess 98 or 97 or something like that is the last time we were at these levels. When I started, dollar yen was 236. So it has been here before, folks. That's the thing to remember. And one of the interesting things about foreign exchange is that I have the benefit of having been in the market for a long time. So I have perspective that many people don't. And folks who've traded if you traded for 20 years and you got in the FX market in 2002, you've never seen dollar yen at 136 and change. You don't think that that's possible. You think this is an all-time high. It's not, okay? And it's true in many currencies. The dollar is clearly stronger than it was a year ago. The dollar is not anywhere near all-time highs. Go back and look into charts of where the dollar was in 1985, when the dollar was truly strong during the Reagan administration, and when the Plaza Accord came out, and the G5 got together and and basically said, hey, the dollar's too strong. We all think that's the case. And they changed monetary policies and intervened. And that was effective. So anyway, I'm sorry, I got sort of sidetracked there. So the rest of my career is I've gone from bank to bank in various roles. I started off as a forward trader. And aside, my master's thesis was actually a pricing model for currency options, which I got done before currency options started trading publicly. It was very important to me because I didn't want to be proven wrong. As it happens, I was proven right.
Hey.
And so let me tell you what, when you know that they're going to start trading in the, in the following month, you wanted to get I wanted to get my paper in there so that it couldn't, I couldn't be wrong instantly. And so I started that way. I started on the forward desk, was trading forward and spot at Swiss Bank. I moved to Chase, where I was doing the same thing. And then one day, my boss at Chase called me aside, and I assumed that I was getting into trouble. And in fact, what had happened was that the options team had up and left and gone to another bank, and they wanted me to sit there while they figured out what to do, because at least I'd written my master's thesis on it, so I had some concept about what options were like, and I never left. I just took to options as it happens, traded there, made a lot of money for them, moved on, worked in other places. Options are really interesting to me because while my basic time was FX options, I also traded commodity options. I took a role trading bond options. Options are still options, whatever they are, equity options. Every market has its own idiosyncrasies, but gamma is gamma and delta is delta and theta is theta, no matter which option which market you're looking at. So I did that for a number of years, probably 14 or 15 years at a couple of different shops, major banks, investment banks, money center banks, foreign banks. And then it was October of 98 when the Russia defaulted.
Right.
Dollar yen moved 20 big figures in 2 days from a 140 handle, and spoke to. I was trading options. I was actually at Barclays at the time. I was trading in New York, and we did not get a single client inquiry on that day or in those couple of days. And I asked the head of the room. I said, does anybody even talk to their clients about options here? Like, we're just 4 guys in the room. We don't see anything. And so I sort of volunteered to move to the sales side. It took a little while, as things happen to take when you work at a bank. But about a year later, I wound up moving over to the sales side. The original plan was for me to cover institutions, hedge funds, things like that, given my trading background. But ultimately, they had hired someone to do that sort of thing. There was an opening on the corporate desk, so I wound up as a corporate FX marketer. And that's what I've been doing ever since, pretty much. Very interesting. I've made my career. I would never say that I'm a salesman of any sort, although that's, I guess, technically my title. I view it as an educational process. What I learned was that most of corporate America doesn't really understand the intricacies of managing foreign exchange risk. And my job has been essentially to teach them how to do it. And that's what I've done for the last 20 odd years.
Got it. No, I think that's very cool. And when you made that shift from trading prop to trading sales, what was that like? Was because usually people tend to try and make a shift from the sell side to the buy side. You sort of did the opposite. So what was that like? And do you have any cool stories from anywhere on the sales or the trading desk?
So the first thing, earlier in my career, when I was leaving, I can't remember where I was leaving. I think I was leaving Lehman Brothers. And I interviewed at Chemical Bank, which was at the time merging with Chase. And the guy who was there said, well, I see you as a sales guy, and I didn't want to give up the trading. I like trading. When you're a trader, especially you're a desk trader and you're trading positions all the time, like it's really in your blood, and not having a position to worry about and things like that. I didn't think that I would be very interested in the other role. As it turns out, I didn't miss it at all. It was really easy to give up. So one of the reasons I really wanted to go was because, again, a story during the emerging market crisis. I was getting phone calls in the middle of the night every night. My daughter was 4, and the phone was ringing. My wife was really annoyed, and it was like, you have to stop this. Like, you can't get phone calls every night. And because so much was going on during the Asia crisis, obviously that was, what was happening. So the sales side changed that a lot. And that became, that became quite good. Ultimately, I mean, a very interesting story. So when I was at Barclays, there were 5, 6 of us who were at the director level in the FX sales group. And every one of us had a very different style, a different approach to how they were effective with their clients doing what needed to be done. And what I learned from that was that there's no one right way to do it. You can be successful in a myriad of different ways. You just have to figure out what you can do best, and then be able to extrapolate that and identify the value that you create. And then your clients are looking for value add. As electronified as the business has become, and it's obviously become so much more electronified over the years, on the sales side, it's still a relationship business. It is talking to your clients, getting them to open up to tell you what they need to do, what their exposures are like, and then coming up with solutions for them to manage those exposures in the best manner. So It has really been very interesting. I've been very, very fortunate. I have no idea how many clients I've covered over the years, a couple of hundred, almost certainly different companies. And at the bank level, we're talking about, these are all Fortune 500 type companies. I don't know, I can think of maybe one or two people with whom I didn't really get along with effectively during that period of time. You learn so much about the way a company works. There's nothing better than visiting a company as a banker to get the vibe of the company. Obviously, COVID has disrupted that process. Travel it was a big part of the job because you were going out visiting clients all the time. But it was very important because you got to sit there, and it wasn't just your conversation with your counterpart that you were discussing, whether it was the treasurer AT, the director of treasury. Those are the sorts of folks that I would speak with. But it was, how did it feel to walk in the building? Were people excited to be there? Were people miserable to be there? Was it a 9 to 5? This was the greatest place ever? And you could really tell the difference. And not only that, you could tell how a company's equity was going to perform based on that difference, because it was a very, very evident feeling that this is a company that people love to work for, and which tells you that they're going to bring a lot of value to market, for those situations.
Yep. And when you were on the trading or on the sales desk, what are the craziest stories that you have from then? Because I think everyone is down for a good Wall Street story. I remember when we were speaking off the record a couple of weeks back, and you were telling me about a CFA franc trade. I think that was super cool. I think that'd be awesome. And super worth sharing.
Well, there are many stories. So I'll give a story from earlier in my career, when I was still an options trader. And actually,
give as many stories as you like, man.
It didn't involve me per se, although I have one of those as well. But it was again a lesson well learned. The bank that I was working for had a large client, internally focused client, that had a system that traded based on the futures close. And what they would do is they would trade on the futures close in Chicago, and if it reached some technical level, and they would adjust their position accordingly. And but they wouldn't trade at that time. So futures closed at 3 p.m. They wouldn't trade at 3 p.m. in New York when it happened. They would wait until the open in Europe. Now, of course, the market could move, 2-3% in that intervening period. So management in New York was very keen to get them to trade in New York, obviously, because there's a chance to make more money. So they worked on the person for a long time. And finally he said, okay, he would do it. They convinced him that it made more sense to do it this way. So he dealt in what they called units, and a unit was $300 million notional. Okay, or 300 million. So in sterling was 300 million pounds in dollar. So now this was before the euro. So it was dollar mark, dollar yen, whatever. It was $300 million. He came in, and in sterling, the pound closed below whatever the level was, and he needed to sell 2 units. So he had to sell 600 million pounds, and it was a Friday afternoon. Now, Friday afternoon at 3 o'clock, 600 million pounds is a really big trade. And the sterling trader at this bank was really feeling, he's like, I'm going to own this market. This is going to be fantastic. And so he goes to his broker. Now remember, there's no electronic trading in at this point. This is a pure voice brokerage market. He goes to his brokers and he said, hey, I need a bid on sterling. What do you got? And I have no idea what the rate was. We'll just say it was 55 bid. So he gets, I'm 55 bid, and he hits the bid. I think he asked for a price on 25 or 50 million pounds. He hits the bid at 55, and the broker comes back and says, I could do a little more. And so the trader goes, fine, yours. And the broker goes, how much? And the trader where I was sitting says, your amount. So your amount is a really, really dramatic statement. Because if he said, well, I need to buy 5 billion pounds, that's what you just committed to. And as it happens, the bidder was the erstwhile Solomon brothers, who apparently had some sort of M&A deal where they needed to buy like 3 billion pounds. So, so the broker comes back and goes, "You're done on 3 billion." And the trader's face goes pure white, because of course he only had 550 million more to sell. So he was terrified at that. It was a long, hard argument to get them to only sell the 600 million pounds, but they finally, that's what happened. They did 600 million pounds. And the lesson, of course, is there's always a bigger fish. There's somebody out there who's bigger than you, no matter how big you think you are. So don't never forget that. It was a very, very interesting situation. So one other interesting story was, so I had a different client. I was at the same bank, as I had a different client who also traded in $300 million units. It was a thing that they did. They both came out of the same office in Paris, I think. In Paris, yeah. And so, but he loved to trade options. So he would call and look for all of these interesting option structures. And I would, listen to what he wanted to do and create things. And so one morning he came in and he was very keen to trade something. He priced up probably 4 or 5 different structures, and very, very different structures, even looking different ways. He wanted to take volatility risk. He wanted to take spot risk. And so finally he agrees, and it was about 8:25 in the morning. And there was a number coming out at 8:30. Finally, he agrees to whatever structure it was. And so based on my pricer, I say, all right, you're done. And I yell over to the spot trader, sell $300 million, because that was the delta hedge. And so I hear where they're selling it. So I adjust the price in my pricer and I realize it gets better. I go, that can't be right. And I realized I sold $300 million. I should have bought them. So now I'm short $600 million, and data points, numbers about to come out. I think CPI was coming out in like 2 minutes. And my boss at the time was a great guy. He looked and sounded just like Henry Kissinger. His name was Wolf Scholkoff, and he spoke with a very, very thick German accent. And I went over to him because the cardinal rule is, if you make a mistake, own up to it instantly. Don't try to hide it. So I went over to him and I said, Wolf, I kind of screwed up here. Because what happened? He said, well, those 300 I just sold, I needed to buy them. So I'm short $600. And he looks at me and he goes, well, I hope it goes down. And that was what he said. That was it. The entire thing. So it all worked out in the end. It did go down a little bit. I was able to buy them back, and it wound up. But again, it is a cardinal lesson if you're working on a trading floor, is never, ever, ever hide a mistake. You make a mistake, you own up to it, you get it done right away, never a problem. You hide it, you get fired. And then, of course, we've seen the things as people pile on to try and save it, and it will never go your way.
Yep. The lessons from all the rogue traders over the last 10, 20, 30 years.
Exactly right. You go back to Nick Leeson, you go back to, I can't remember who's the guy for SocGen in Paris.
Jerome Curviel.
Right, Curviel. I mean, it never goes your way. That's just the way. The markets know enough to know that if you've made a mistake and you're hiding it, it's going to hurt you.
Yep. And how have markets evolved from back when you started versus what they are today? One, they've definitely become more electronic, they've become more algorithmic, but in the way they trade, have you seen notable changes, in the way prices behave, etc.? Or do you think they're relatively similar from what they were back in the 80s and 90s?
They've changed very dramatically in my estimation. Clearly, electronification of the market has been by far the largest change, but in a way that I would argue most people don't really think about it. Before markets were electronified, before everybody had whatever, so a Barks or a City Velocity or whatever on their desk, all trades had to go into a trader's book, right? So the dollar mark trader or the euro trader or the sterling trader, whatever clients did, if it was nothing, small stuff or larger stuff, it all went to his book. So the trader knew what was going through the market. Right? The trader was sitting there, and if he had 20 different small trades going one way, he knew that there were people who were interested in selling or interested in buying, whichever way it was. Now the trader never sees that because that all gets done electronically. So as a trader, I think it's much, much more difficult because I don't have any background information. And one of the things that goes on, in fact, there are many fewer spot traders in the market. And I think the problem for them is that their job has not become making markets all the time. Their job has become, when a client comes in with a very large interest, they don't want to do it on the machine. They want to try, and they want a risk transfer price. As the trader who's sitting there, and maybe you're trading back and forth in your book and whatever, but you're not seeing all the stuff flow into your book to see which way things are. How do you know what's the right price on 500 million or a billion or whatever the number is, without sort of being in touch with the market in the same way? I mean, when I was a spot trader, you know, like I'm going to say I was a spot trader in cable probably under 2 million pounds. We didn't even, like, the salespeople didn't even ask us. They just, like, they took it off the screen and they put it in the books, and they would tell us, hey, put this in, put this in, put this in. But you could see what was coming in. Now you never see. So I think that's one of the big things. I think the high frequency guys I think they've actually damaged the markets greatly because they're not market makers. They have no obligation to make markets. And so while they've certainly gotten better, we've seen a number of flash crashes. I distinctly remember October of 2016, whatever happened in cable, we fell 10 cents in 10 minutes or something like that. And at 6 in the evening, in the twilight of markets, what I call that time. But what they've done is they've effectively narrowed the bid-ask spread, which means that market-making banks don't have the same incentive to make markets because their bid-ask spread is narrowed where they earn their living, but they're still required to make markets when there's no market. So if something happens, ding, 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 Fed hikes 100 intermeeting, there'll be no HFTs that'll be making markets in FX. The first prices come back are all going to be traders. It's going to be a person who's making that price. And I think, so if you combine that with the fact that over the course of my career, the banking industry is dramatically consolidated. Back when I started, there were probably 1,000 or 1,500 or 2,000 banks around the world that were actively trading foreign exchange. Like, they all didn't trade every currency, but there must have been 25 or 50 German banks and the same number of Japanese banks that were trading yen or trading Deutschmarks. So there was always some liquidity. Liquidity was pretty deep because there were lots of folks doing it. They've all combined into, I don't know, if there are 100 banks these days, that would be a lot in my mind that are sort of active in the foreign exchange market. So the depth of liquidity has, in my estimation, is really dramatically reduced. There are pockets of liquidity. I think that you find that, and you find that when you have something large to do, you may see it move 20 or 30 pips, and then all of a sudden there's activity there, and you can fill it in. But when I first started, to move dollar mark, which was the pre-euro, 20 or 30 pips was a lot. You needed to do a lot in that market. Listen, the BIS gives us the triennial survey. The number keeps growing, so arguably there's more and more business going through. I think a lot of it is machine to machine. I think that it may be less visible to us because of that. But just the behavior when I have a larger client order that I need to execute, I watch and see that it's not, it doesn't behave in the manner that it did, 10 years ago, 15, 20, 30 years ago. It is definitely changed.
Mm-hmm. I see. And when it comes to, for example, so Stan Druckenmiller, when he was on Real Vision a few years back, so he talked about how he used to previously use price action in news. So when say bad news came out, but then the price action didn't move according to that bad news, then previously his analysis would have been that bad news would be worthless. However, he's not able to do. So he's not able to do a similar kind of analysis right now. And so, I think that's interesting in the sense that the way, or the way that people used to analyze markets back then, a lot of people would also jump on board when they saw, say, Soros or Druckenmiller or Robertson put on a trade. They would just hop on board and ride the same trend as them. You're not really seeing that happen these days, are you?
No, I agree. I think that there were those guys, Lewis Bacon.
Yeah.
There were a number of major macro hedge funds, and when the information would get out, I mean, a lot of times they wanted that information to get out because they knew that if they started, they did whatever they did, and then other people were going to jump on the bandwagon, would just move it in their favor. So as long as they got done before people started to find out, they were all about it. And I think that is not, I mean, first off, the macro funds haven't had the same impact because of changes in markets, because since the great financial crisis, we've had central banks anesthetize markets in a big way. What we've seen in the last several months, which of course is much more volatility than we'd seen in the previous, take away COVID, the COVID spike in 2020. But prior to that, I mean, you can point to the volatility times. So when China devalued in August of 15, you had volatility for a couple of weeks. When the Powell pivot in 18, the European bond crisis, the debt crisis in 2012. But the point is that you could simply point to, well, this is what happened at that point in time. And so markets were choppy and then they settled out. When I first started, markets were choppy at all times. So a good indication, you can look at what implied volatilities look like. Now, they're probably not great records of it then because people weren't sort of tracking the data, but having traded through there, what options volatilities were, the euro, well, I mean, dollar mark, which was, again, the dollar mark was the euro before the euro. Dollar mark was probably, it was between a 10 and 12 volatility currency. So the euro spent however many years at between 6 and 8. So I mean, that's a really, really big difference. So where are we this morning? So it's back to 9. Okay, we've had, now it hasn't moved that much. Lately, it's been kind of chopping back, within a range. But if you look across, whether it's sterling, whether it's dollar yen, I mean, dollar yen was a 12 to 14 vol currency. I mean, it moved all over the place. And in October of 98, when things went nuts, it went to 40 vol. Now, some of the emerging market currencies, those are a little bit more, what I would just call normal. I mean, Brazil at 16 or 18, or I don't know, let's see, where is it? Brazil is at 19, is not that, I mean, that's kind of in the right place. Mexico at 12 and a half is cheap. Mexico was more of a sort of 15 vol currency. So we've had since QE1, right? So go back to whatever it was, 2009, QE1. We've had a constant addition of reserves and money suppressing volatility. And I think the central banks were very happy with that. The central banks hate volatility. Like I used to suggest that central bank wanted to really keep a currency in a place. What they should do is they should just sell every day. They should sell overnight options at the strike they wanted. If you sell $1 billion of overnight options constantly, I assure you that spot's going to stay right there. Even if the market knows it's coming, it will work to dramatically decrease volatility. And so I think that's, we've been living through that. And one of the interesting things is, how are algorithms programmed? They're based on the last 10 years of data. Well, the last 10 years of data in 2012, we've had nothing but QE, right? None of these algorithms know anything about what the world was like pre-QE. So if we're getting rid of QE, why would we think that they're going to work effectively? I think we're coming to much bigger. I think volatility is likely to remain high going forward as long as the tightening cycle continues. If we see these banks tighten, raise rates, we see banks, the central banks tighten, reduce assets, I think that volatility is going to definitely increase. Of course, the big question is, will they actually follow through and do all that? That's the $64 trillion question.
Got it. And I don't know if you've read a book called The Rise of Carry by, I think it's Jamie Lee, and there's a couple of other authors, but it was fascinating because it talked about how central bank policy over the last, give or take, 10 years, so since the post the Great Financial Crisis, it's the dovishness of central bank policy has done a great deal in suppressing volatility, and so carry trades are shortfall trades. So every time starts, you see these carry trades start to unfold. And so I wanted to ask you, so do you still see that dynamic when it comes to places like Japan and the Swiss franc? So to what extent do they still hold their safe haven status, and more importantly, do they how much of that is just caused by carry trades unwinding?
So I will tell you that I have, having been sitting on the desk when the financial crisis hit back in 2008 and watching what was going on, and it was a very scary time. I recall questioning whether like credit cards were going to work afterwards, because banks were basically shutting down and they were like, no, we don't want to do anything at all. But corporates, they still had to do what they had to do. So, it became much more difficult. Bid-ask spreads exploded wider. The euro dollar, which was a pip wide all the time, was 10 pips wide. You want a little story? A very large conglomerate who was very active in foreign exchange markets right after the Lehman Brothers bankruptcy. So it was like it was that Monday when the world was ending, and came in and said, we need a price on, it was a swap. It was a forward. They wanted 1 month or 3 month sterling swap on 300 or 500 million pounds or something like that. And so asked the trader, and so 3 months sterling should be 0.3 wide or something like that. And the trader made it 15 wide, 10 or 15 wide. And the client was livid. What are you talking about? This is 3 months. And I said, you may not have noticed, but markets have adjusted here. This is where it is. He slams the phone down. Okay. I wasn't about to change anything. I wasn't going to fight for him. Half hour later, sheepishly, he calls back and goes, are you still there? Because obviously everyone was in the same place. And so at that point, by then the market had actually moved. And so there's still the same bid ask, but the market had moved. So whatever. People get very used to whatever they're used to. And especially if you're a large corporate who's active, many of them seem to believe that, the bid ask spread is for peasants, and for them, it should be, mid-market is what they should get. And in scenarios like that, it's just, there is no mid-market, so that's what goes on. I think that their premise is exactly correct. Sitting at the desk during which is what I started to say, sitting at the desk during the financial meltdown, prior to the financial meltdown, the trade was short yen, long picket. Brazil, Mexico, dollars, euros, Aussie was a favorite. Aussie was a favorite with the Japanese retail crowd. But people were shorting yen to buy stocks, to buy bonds. It didn't matter because funding in yen was the cheapest place to fund. It hits the fan, right? Lehman goes, the world changes overnight, and markets seize up, and risk managers everywhere in the world went to their risk takers and said, shut it down. I don't want this risk right here. And so when you're shutting down risk and you're short yen, what do you got to do? You got to buy yen. So the yen rallied alongside the dollar in 2009. And I would argue that a huge proportion of that was short covering, simple short covering yen. However, the dollar was fear and, buying bonds, which always struck me as odd. Like the problem was in the US financial markets and people wanted to buy treasuries. It struck me that you would like bunds would have made a lot more sense to me. Treasuries, maybe not so much, but that was the way it went. So people were buying dollars to buy bonds, and as they were getting out of everything they could, but they were also buying yen. And they were just buying yen to cover their shorts. However, what I would argue that there was a sort of a conflation of the idea that the dollar was a safe haven and the yen was people covering their positions, and it sort of rubbed off on being a safe haven. And I get, listen, financially, the Japanese were a current account surplus, trade surplus country. I get all of that. It didn't matter. It didn't behave in that manner. But that's what went on. So I feel like a big part of that was that it was less haven and more position. And I think you can look at it today. I mean, since March, we were up 20 some big figures in dollar yen, right? New highs overnight at 136 and change, as the BOJ said, no, we're sticking with it. And I feel like, it still seems like it's a pretty risky environment. The dollar's rocking, but the yen is not behaving in any sort of haven-like manner. And I think that, this is, look, maybe it's just a temporary situation because of the rate differential. And I think the rate differential obviously has a lot to do with it. But I think that if my comparison is gold is not weakening, it's not strengthening, but it's not weakening in this risk. I mean, if you look at gold versus yen or gold versus euro, gold is, has rallied strongly. The yen is just straight up weakened against everything, except maybe the Turkish lira. But that's a whole nother story.
Yeah. Moving on, I wanted to get some of your takes on where markets are today. And so, I think we should definitely start with dollar yen. So, these are, dollar yen higher, lower, and, how are you thinking about just in general FX markets today? Where do you see opportunities and risks?
So at this point, nothing has changed my sort of broad-based thesis that has evolved over the course of the last X months, that the market perceives the Fed as being the most hawkish of the central banks. Of the major central banks. Clearly the central bank of Brazil they raised rates 1,125 basis points or something. Like they were clearly a lot more hawkish. But of the major central banks, the Fed continues to be perceived as the place that is most hawkish, that rates are going to move further here than elsewhere, and that's underpinning the dollar overall. The yen, I had shown this chart to my clients prior to going. I was on vacation the last week and a half. If you look at dollar yen and the 10-year treasury, they go tick for tick with each other, literally tick for tick. So I would argue that the yen is really following the treasury, which makes sense because the Japanese, the BOJ, has made it very clear that they're not about to change their policy stance. They don't think that the inflation is. They're still in the transitory inflation camp there. Let's put it that way. And they don't think that it's sustainable. It's just commodity-led inflation. They can't do anything about it. And so they're going to do that. And apparently the Japanese government is likely to, ironically, add more fiscal stimulus to help the people, the Japanese people, cope with higher energy prices, higher food prices, and they don't seem ready to break anything. It strikes me like if there was a trade to put on out there, and I'm not advocating anything. I'm just sort of looking at what's out there. I would say, boy, I would want to own puts on the 10-year JGB because it feels hard to believe that they can maintain it indefinitely. I mean, maybe they can, but they've already done so much damage to the JGB market. What was it, a week ago Friday? How many JGBs traded? How many 10-year JGBs traded in the market? Zero. Okay, it's not actually a market if nothing trades, right? So to me, they've incalculably damaged their government bond market by what they're doing. They own, I don't know, between 40 and 50% of all JGBs outstanding. And so that strikes me as a place where I was listening to somebody this morning. It was like a currency peg. Think about, so go back to 1998 into 99 when Brazil had essentially their currency peg. They had a crawling peg, and it broke, and and dollar Brazil went from 138 to 250 overnight, and then went to 4 and then came back. Anytime a currency peg breaks, it's because there's so much pressure that ultimately the central bank can't handle it. In 92, when the pound exited the ERM, same thing. Too much pressure, they couldn't handle it. That was the big Soros trade, right? So it feels the same. Like they're sticking to their guns, dig in their heels. We're going to buy as many as there are. We're bid for all of them. They may own all of them. I mean, I guess if they buy all of them, then they can't go any lower, right? they can own it. They can keep it there. But it strikes me that the pressure is going to become too great for them to maintain that. And when that happens, I think that will truly be an earth-shattering change. Dollar yen will reverse course very, very quickly. However, until that happens, how high is up? 140, 145, 150, they're just numbers. And as we were talking before we started, when I started in this game, dollar yen was 235, not 135. It's been there before, folks. So, there's no reason that we can't go back there. There's nothing fundamental preventing it, especially if the Fed is truly as hawkish as they tried to sound last week. The euro is, to my mind, the euro is held up extremely well because I think that the structural impediments to the euro are becoming more obvious. So much so that Madame Lagarde explained that fragmentation was something that they're trying to prevent. Now, I got a kick out of there are tools we have and we'll be implementing new tools if we need to prevent fragmentation. So I can pretty much tell you what those tools are. Those tools are, they're going to buy BTPs. However they couch it, whatever they're doing, they're going to buy BTPs. Now, they may buy BTPs and sell bunds because they own a lot of bunds, but they're going to buy BTPs, and I assume they're going to buy Greek government bonds, and they're going to buy, bonos, and I don't know what Portuguese bonds are called, whatever. But they're going to buy them all because that's the only way to do it. And it has to be very clear so that the market goes, okay, they're buying them, so I can still buy them, because no one wants to buy them, certainly not at these yields. If Italian 10-year debt was yielding 8% or 10%, yeah, they would find buyers. Because in this environment where everyone else is yielding 2% and they're at 10, people would go, yeah, I'll take that risk. That's the right risk. But yielding 2 or 3.5 when bunds are at 1.5, that's not really so attractive. That's my view. So to me, the euro, no matter how hawkish they try to present themselves, the ECB cannot allow spreads to blow out, and therefore they're never going to really tighten that much. So the euro, in my mind, the euro has further to fall. As long as the Fed remains hawkish, then the euro has further to fall. And I think that's probably generically true. As long as the Fed remains hawkish, then the dollar is going to continue, not in a straight line, but it's going to continue to outperform overall. The question, which then begs the question, how long will the Fed be able to continue to tighten? We saw a big re-rating at the last meeting where, the long-term view of interest rates didn't really change, but the 2-year view went from 2 3/4 to near 4. Obviously, that's, significantly different framework. And I think the dollar will benefit from that. As I've said before, as much as the administration hates inflation, I assure you they will hate recession that much more. And if, as I believe, and I'm not alone in this belief, there are many people much smarter than me who have been saying something of the same thing, the Fed is tightening into what is a pending recession. And it wouldn't be surprising to me if we're in that recession right now. GDP now is back to zero. We get a little bit more weaker data. We're going to have Q2. If we have a Q2 negative print, it's very easy to see that, hey, the US is going into recession and the Fed's hiking rates aggressively. That doesn't really work well for the economy overall. And my view is that that could easily be, a breaking point where the Fed will blink essentially, and we'll go, okay, we've done enough. At which point the dollar will reverse. But no idea when that is. I would estimate it's measured in months. By the election, I would guess that by the election the dollar will be a lot lower than it is now. That's my view.
And when you say election, you mean the midterms, right? In November.
The midterm. I'm sorry, the U.S. election, the midterms. That's correct. I feel like listen. If I'm Jay Powell, I'm pretty happy with a strong dollar, because a strong dollar is one of my best tools to fight inflation.
Reduced input costs. Yeah.
So, think of the advantages that we have. The commodities are all priced in dollars. Okay, so we're not getting that double whammy that the Europeans are, the Japanese are, that the Aussies are, everybody else, their currency is weakening and the price of the commodity is going up. So we miss that part. Plus, whatever we buy from anybody else, well, it's in dollars. So as their currencies weaken, we get more for it. So to me, a strong dollar is not at all something that the Fed is concerned about. In fact, I think that they're thrilled. They'll be concerned if it flips around. Again, we talked about the Plaza Accord in '85. Like back then, everybody in the U.S. included was terrified of a too strong dollar. What came out of that was when you had the voluntary restrictions on Japanese auto imports. The Japanese car makers were reduced their amount of exports to the U.S. on basically because Reagan threatened them, and
yep.
And a strong dollar was a real problem because the U.S. manufacturing capacity was really negatively impacted. I don't think that's the situation that people perceive at this point. I mean, the economy has become much more service oriented. The fact that inflation is running high, a strong dollar is a benefit. And I think that's, I think that the Fed is quite pleased with it. Their bigger problem is going to be when they blink, when things change, the dollar is likely to fall and fall quickly, in my estimation. And if that happens, that's going to be a problem for inflation, right? Because within months thereafter, inflation readings are just going to get higher again because all of our import costs are going to just skyrocket.
Mm-hmm. Yep. And what's interesting from what you said is it seems like BOJ at the moment just seems to be behind every other central bank. And so do you think that eventually the BOJ will be forced to conform its monetary policy to what every other central bank is doing right now, which is tightening financial conditions and tightening tightening monetary policy? Do you think that the BOJ will eventually be forced into doing something of that sort?
That will only occur. That will be a political question. It's not a monetary question. It is only going to occur at the point in time where the Japanese people essentially say enough is enough. However, that is reflected to the administration, the Kishida administration. It's like, we can't keep doing this. We need to change. It will become increasingly clear to the administration that they can't maintain the current set of policies if the yen continues to weaken. Because, again, while export companies, things are great because the yen is weaker, the problem they've got is that, Mr. and Mrs. Watanabe, who are our
Japanese friends,
right? The Japanese folks, if they want to go somewhere, they still have to fill up the tank, and God knows that gasoline is $5 here. It's going to cost, 15 a gallon there, or 12 a gallon. I haven't seen any numbers. I know in Europe it's 10 to 12. Would assume it's going to be a similar number there. People are going to say, look, we can't afford to do this. We can't afford to keep spending this much on food and energy because we can't buy anything else. And so I feel like that will be the breaking point. But your guess is as good as mine as to when that might happen. It could take 3 years. Like literally, it could be 3 more years that the Japanese, by which time the Fed will have reversed course and other banks will have already reversed course, and then the pressure won't be there for them to do it because the yen will have rebounded. You know what I mean? Like it's very easy to see that they could stick it out, not change at all, and have other central banks come back to them during the next downturn.
And they'll be fine, yeah, and just kick the can down the road. One more thing, Andy. So when it comes to literature in the FX and the FX option space, what are your favorite reads? And because just in general, so if you look at, say, value investing, so buying a stock below or buying a company below what it's worth, there's a ton of books on that type of investing. However, when it comes to, say, macro investing or even more specific FX, there doesn't seem to be as much literature that's directly useful for trading per se. And so, do you have any good reads or recommendations when in this space?
It's funny. You're correct. There's a relative dearth of FX books in my estimation. I think part of that is because, despite the fact it's the biggest market by far, it's not well known, at least not in the U.S. Look, you go to Europe, every cabbie knows the value of the euro versus every other currency. Here, most people don't even understand there is any other currency. The dollar is the dollar, and that's what it is. So, from an options perspective, I was, when I was first starting out, so when I first started out, there really weren't that many books. Fisher Black was my Finance 101 professor of the Black-Scholes model. So he was actually the guy who was my first guy. The options book I liked the best was the Macmillan Options Theory. Options, I got to see it on my shelf here. Strategic Investment. What is it called here? Options as a Strategic Investment. Options as a Strategic Investment by Macmillan. That one I thought was a very good book. I thought it did a very good job in sort of giving you an understanding of how options can work and how you can utilize them. But remember, when people talk of options, they're essentially always talking about stock options. It's all, and a funny thing is, stock options are all American style, right? You can exercise them anytime up to and including the expiry date.
European.
The foreign exchange market is a European style market, exactly. You can get an American style option, but that's the exception, not the rule. The rule is it's a European style exchange, which is much easier, right? Modeling European style options is much easier than modeling American style options because there's a closed form solution. Black-Scholes gave us closed form solution. American style, not so much. So, but that is actually the one options book that I really helped me a great deal when I first got started in the process. I think it's still timely. There's nothing, options are still options. They still work exactly the same way. So as to the FX markets, I don't know that I've ever read a book on the FX markets that I thought was really a good read that gave a good description of stuff. And lately, what I've been reading I'm reading a book, Devil Take the Hindmost, which is a history of speculation, very fascinating book. The Death of Money, about the Weimar hyperinflation. Here's a book that I really enjoyed and hated at the same time. It's called The Mandibles. I cannot recommend it highly enough. Mandibles, the mandible, like your jaw, mandible. Which is a fictionalized account of what life in the United States would be like during a hyperinflation.
Wow, that sounds
sometime in the not too distant. And I think it was incredibly well done. The reason I hated it was because it was incredibly believable. The reason I liked it was because it was really well done. And I think I think it should be required reading for everybody in Congress so they understand what they're doing and how it can work out.
Yep, absolutely. Well, Andy, thank you so much for being on the podcast. It was absolutely wonderful to have you on.
Oh, thanks a lot. It was my pleasure. Completely my pleasure, Sri. I really enjoyed it.